Hi, everyone. Welcome to the Timing Research Show for August 8th, 2016. Today we will be talking about the 150th weekly report from Timing Research. So if you haven't had a chance to take a look at that yet, just go to TimingResearch.com/reports, and you can download this or any past report there. My name is David Kosmeter. I'm the creator of Timing Research, and I have Dave Landry back today to take over hosting. So I'm going to go ahead and turn it over to him.
Okay, thank you, David Kosmeter, and thanks again to Timing Research for having me back once again. We've got an interesting lineup again this week: 2 veterans and 2 newbies. For you newbies, we're going to be quite gentle on you. Don't worry about that. One of the controversies of the show now, maybe today might be a standout, but one of the controversies is that there's just not enough controversy in the show. So we'll see how today goes. Maybe we'll change that today. Andrew, let's go over to you first. Tell us a little bit about your trading and tell us a little bit about alphashark.com.
Yeah, my name is Andrew Keene. I've been on the show, so I consider myself a veteran. I traded at the Chicago Board Options Exchange for a decade in 3 pits, GE, Apple, and Philip Morris Altria. As a market maker down there, before basically all trading went electronic. About 4.5 years ago, I launched my company. We have the second biggest all-day audio and visual trading room in the world, where a retail trader can basically sit behind and watch a seasoned veteran trade. I trade 100% of my capital, 100% of the time with my own money. I trade through Thinkorswim, and we also have about 14 educational courses on demand and DVD. You can go to alphashark.com to see a list of our products. That's about it.
Cool. All right, let's go over to, let's see who's next on the list. Let's go over to you, Jim Kenney, another veteran of the show. Tell us a little bit about your trading and tell us a little bit about optionprofessor.com.
Well, Dave, optionprofessor.com has DVDs that are available that go through the litany of option trading. Lots of moving parts, as we all know, on option trading.
You stole the word out of my mouth. Go ahead.
Yeah. So we try to simplify it to get it to the point, make people understand the use and the risk of all the different strategies, and after you put the strategy on, how you might adjust the position one way or the other, what environments might be best for different strategies, and basically so people know what the heck they're doing out there rather than just running down to the discount broker and trading their brains out with half the knowledge they probably really need.
Gotcha. Okay. Jason, let's go over to you. Jason Pearce with smartmoneyinvestor.com. Tell us a little bit about yourself and tell us a little bit about your trading over there at smartmoneyinvestor.com. And welcome to the show.
Well, thanks, Dave. I've been in the futures industry for about 25 years. My dad was a trader and a broker, several family members, so of course I got into the commodity business. Things evolved. I developed my own systems. I'm an expert in what not to do. So in the few things that didn't result in catastrophe, I put together and created some very simple but robust trend-following methodologies. And I hooked up with Smart Money Investor. We created some systems teaching people how to trade and showing them, how to do it themselves. Instead of just giving them the trade and giving them a fish, we've decided we're going to teach them the fish.
Cool. Okay, and then last but certainly not least, Barry over at TopDogTrading.com, another new guy to the show. Welcome aboard, Barry Burns. Tell us a little bit about yourself and a little bit about your trading over at TopDogTrading.com.
All right, thanks, Dave. Yeah, so interesting. My story is somewhat similar to Jason's, actually, which I didn't know. My dad was a trader also, and he started teaching me at the ripe old age of 8 years old. I started my trading career. So I'm 57 now, so that's, okay, more years than I care to actually say out loud. But so I started out as a stock trader and then got some other mentors and went over to futures and then commodities and options. So I kind of trade it all now, and went through a lot of different mentors over the years. Went out to Chicago, got an apartment, worked with a floor trader out there for a while. That was a real eye-opener, and eventually put together my own method. It kind of went full circle. I started out simple, and then I got really smart, so I created these very sophisticated methodologies, and then when I went to Chicago, what those guys were doing was brain dead simple, and they were making a lot more money than I was, so then I simplified my methodology and came back to simplicity. But it works great. It's very robust. I use it for day trading and swing trading, and now I teach other people how to do what I do.
I bet they were buying things that were going up and selling things that were going down.
Absolutely.
Isn't it amazing? We all go through that. I actually do a whole speech just on the trader's journey, where we just add all this complexity, and before you know it, we're all the way back to the beginning again, which is kind of cool about the business. To those of you who don't know me, I've hosted a few times. My name's Dave Landry with TimingResearch.com. I believe you can only predict the short term when it comes to markets, but the real money's in the long term. So that creates a bit of a dilemma whether you should trade for short term or long term, and my answer to that is yes. If it's cloud and thundering, which it looks like it is outside today here in Louisiana, southern Louisiana, we'll probably have a thunderstorm soon. It'll probably be raining soon, but we don't know if it's going to be raining this time next week or next year or whenever. So my point is that I think trading, predicting the markets at least, is akin to predicting the weather. You can only predict so far out. You can only predict so far out, but you can follow trends forever. I have a 21-page report on that. It's on my website if you're interested. Just go into the store. I'm going to walk through the gift shop first. But down below at the bottom of the store, there is quite a few free reports. And then I have tons of content on my website. Now I'll touch upon that towards the end of the show. Andrew, let's go back to you. And let me get the sheet in front of me, make sure I get the right one. I always misread it a little bit. But basically, what direction do you think the P's are going to go, the S&P 500, between now, I guess today's open, and Friday's close, which is August 12th? And once you give me that answer, rate your confidence to that answer by estimating the probability you have correctly predicted this week's market's move.
Yeah, so I've been pretty bullish throughout this whole move, but we are in a 40-point range in S&P over the last 18 trading days. A lot of that, there was a big institutional order flow on a 1x3. Basically, a trader was selling a lot of volatility, and that's why the market's really not moving. There's actually a lot of stories about basically all the institutions are long gamma, so the market's not making these kind of moves they used to. So if I had to say, I think we do go higher, but I'm really right about 50-50. We made basically a tail on top at 2183 today. We're off about 8 points from the highs, but 50-50. But I do think we go a little bit higher.
So the gamma plays what's containing this market, right? That's what you think?
Yeah, that's what's kind of pushing the S&P not really to make the violent moves. We went through Brixton, and then we just went straight up. And if you look at the move that we made in the last 18 days, a 40-point range in 18 days is pretty remarkable.
Yeah.
And I think it's controlled by this one institutional order.
Oh, cool. Well, I spent a lot of time about just traded options, and he had a saying, gamma gets you. So I'm wondering if the gamma is going to get him and get this this market moving again. Let's go over to you, Barry. What direction do you think the S&P 500 will move from today's open to Friday's close, and that's close to the 12th? And once you answer that question, rate your confidence to that answer by estimating the probability that you have correctly predicted the move.
All right, happy to do that. I'm also bullish at this point. I just look at the technicals, the charts. I'm a technical trader. I agree with you, Dave, that it's much easier to establish a probability scenario for the short term than the long term. So even a week for me is kind of long term. It depends what chart you're looking at, I guess. But so I look at a weekly chart, for example, right now, just to say, okay, from today to Friday, that's one bar on a weekly chart, and that even is hard to know what's going to happen. In fact, nobody knows what's going to happen. I asked God, but He didn't give me an answer. So if anybody knows, He does, and He ain't talking about it. So, but
yeah, what
I'm
I often say is,
certain.
Go ahead. I'm sorry.
I was just going to say, as far as my confidence, I'm 100% certain I'm willing to bet your life on it, Dave.
Oh, well, I often say it finds its way into nearly every column, the last column. In fact, no one knows exactly where a market is headed. Not you, not me, and not the guy who screams on TV is what I normally say. Jason, you're up next. In case you guys are wondering, I'm going in order of the way you were signed in to the software. So, Jason, you're up next, and then Jim, you're going to be after Jason. But what direction do you think the S&P 500 will move between now, or I guess today's open and Friday, and then rate your confidence to that. And before you answer that, in the next section, if you guys want to share some charts when you talk about what's happening in the markets, feel free to do so, and we'll talk about that in just 1 second. But first, Jason, let's get your answer to that question.
Well, I'm a trend follower, so both because the previous two guys said they're going to go up, I'll follow that trend and say up. But really the reason I'm saying up is I'm looking at multiple time frames. My monthly time frame, the S&P has been above the 10-month moving average since March. My weekly, we've got 5 weeks in a row with higher highs. 4 of those 5 have higher lows as well. The only one was last week, but that was the outside bar with the upward close. And finally, the daily. You know, what I really like on that daily is early July. We finally broke above that May 2015 high. We've never gone back below it. We went sideways for 2 weeks, had that little pullback last Tuesday, and then shot up to new highs on Friday. So, to me, heading north is the path of least resistance. And
Cool.
I'm probably, you know, I'm not as confident as Barry. I might be willing to bet your life on it, but if you're betting my life, I'd probably say 51%. I'm a little bit more bullish than bearish.
I gotcha. Okay, Jim Kenney, you're up next. Same
Sure.
bat question, same bat time. You know the routine.
Yeah. All right. Well, this is my opinion on the SPX anyway. I would expect it to go lower this week, and the reason I'm saying that is that the transports today went up to 79.37. They're backing off, and the S&P SPX went up to 285, and it's kind of meandering. And we've had a very big run, as some of the guys were saying. And unless there's new, fresh news to jump on here, there could be a few people who want to take profit. But as far as confidence level, you know, it's got to be in the 50-50. I was listening to CNBC Asia last night, and Dennis Gartman was on, and he was bemoaning the fact that every time he shorts, he gets kicked out and loses money lately. So I was wondering, if you wanted to get short, maybe you'd want to wait for some weakness or some confirmation that the thing has ended before you just keep jumping in front of a freight train.
Or wait for Dennis to get bullish.
Yeah, or wait for Dennis to get bullish. But I was wondering if Andrew had something here, because he seems to track the traders pretty good. I was wondering, during this kind of an advance we just saw, you know, obviously somebody might want to try to figure out if this is, you know, just short covering into, or maybe a little bit of spec buying. In other words, who's on the other side of these trades when we see this kind of a jump? Is it, you know, is it the public actually selling into this thing, or who is selling into this thing? And is there any kind of a commitment of traders report on the S&P, Andrew, that would indicate who's on the other side of this rally?
Well, obviously, any rally is just a supply-demand curve between buyers and sellers. And I talked about the one institutional order. It came in about 3 weeks ago. So basically, the way that it works is some institution somewhere in the world comes up with a trade, and then they shop it around to every desk to Citadel, Goldman, Merrill, Morgan, and then they bring it to the pit, and the pit trades it as well. So the market makers in the pit and the institution. But the one order that I saw that was really interesting, that I talked about 3 weeks ago, it was a 21.25, 21.85, 1 by 3. So the person that created the order is the initiator, and he sold 3 of the 21.85s. And in a market that just grinds straight higher, this guy is absolutely crushing it. I think he's made like $100 million. So the institutions that took the other side of the trade is they looked at, you know, the VIX trading 12.5, 13. They're like, this is cheap. You know, we can make money being long this gamma. And we don't move. I mean, I watched the S&P trade overnight. We don't move. The futures have been in about 4-point range all day today. Like, they're just not moving at all. And I think a lot of that is because there's one person that initiated it. So I think up here, you know, it's interesting. Like, the Brixton news came out, and I don't think any of the 5 of us would ever say the Brixton news came out, we sold off so hard, and then we'd never see a sell-off again, and now we're trading at all-time highs. It's like it didn't matter. If it mattered positively. So, you know, I really cut back a lot of my personal positions. I watch institutional order flow in the option market, so I watch it more in individual stocks than I do the overall market. I don't watch SPX and SPY really trade that much. But that's a very, very good question.
Yeah, and on the commitment of traders question, you know how like on the grain rally there was a lot of commercial trying to sell into that rally, as opposed to, and then of course the prices have dissipated quite a bit in grain. In a situation on the S&P, is there a corresponding commitment of traders who could tell you what bigger institutions are doing into this rally, or bigger market makers might be doing in this rally?
I mean, yeah, you can watch. I mean, you can get a squawk box of like the futures, but the thing about like the S&P in the option market and in the futures, they can be hedged against so many different positions. So that's why I don't watch a lot of that, because a lot of times if they sell straddles in the S&P, then they go sell straddles in the VIX. So the VIX and the S&P is really correlated, and a lot of institutions like Goldman Sachs buys like a call stupid once a month, every month, to protect their long book. So there's a lot of games being played. You know, they all have algorithmic programs of what their models tell them they should do. So I don't watch that institutional order that much. But like I said, I totally agree that it's a very challenging market to trade, and I'm mesmerized that we're trading on all-time highs after the Brixton news 4 weeks ago.
Right.
Well, that showed two things. One, it sold out so hard, and I had signals that had triggered last summer, so I thought that was going to be the real deal. But then the market came right back, so it told us two things, which sounds like talking out of both sides of my mouth. But number one, this market is very vulnerable and could easily sell off. And then number two, the fact that it bounced right back shows that it has strength. But I like what you were saying, Andrew. Like that's going to be the last sell-off we'll ever see, and I think it's the one that you don't know about, or the news that you don't see coming that's going to kill you. And I'll flesh out some of those things in the next segment. Now, before we get to the next segment, just want to remind you guys two things. One, if you want to show charts when we come back to you, Andrew, you'll be next. If you want to share your screen and show some charts, that'd be awesome. And number two, there's a new feature that we've added, or actually I think Wiz added a few months ago, free trade of the week or free trade idea of the week. So if there's a trade you want to throw out, please start thinking about that now. Now, with that said, or with that out the way, I think the market's going to continue higher. I did, as I said earlier, have a sell signal last summer, and we negated that sell signal recently when the market started making new highs. And one thing I'll flesh out here in just 1 second is we did have a volatility breakout. The range got very narrow, as you know. Traders usually don't agree for long, and you got to be careful taking that first expansion when the volatility begins to contract. And we had an expansion to the downside, and then the market turned around and went straight back up. That'll actually test out. I don't do a lot of mechanical testing anymore, but years ago I did, and that does test out over the short term. And I think part of the bounce that we've seen lately is based on that, and I'll flesh that out in just 1 second. So I think we're going to head higher. Just as a trade follower, I'm not doing anything fancy. I'm just saying, okay, well, be new highs, and we get more new highs, and I'll give my confidence of about 60%. I think predicting efficient markets is very difficult, and I think it was Andrew was just saying a lot of games are being played, a lot of hedgers, a lot of I don't know, tokers, jokers, midnight tokers, whatever, or in the market, and those players tend to cancel each other out. So I'm going to show you, when I get to the trade of the week, I'm going to show you something incredibly inefficient, and which should be kind of an interesting type of trade. Anyway, higher 60%. Let's go back to you, Andrew, and if you want to show us some charts or anything, let us know. And for your answer to that question, please share what specific reason you think the S&P will be headed higher, or headed the direction you choose, which I think was higher in your case.
Yeah, I just tried. Is it showing my screen right now?
Not yet, but it might just be on my end.
It says you're sharing screen.
I can see it.
Okay. I can see it.
Oh, there it is. There it is. Okay, cool.
Yeah,
Okay,
so
look at
basically what I watch this proprietary-based scanner throughout the course of the day, which shows institutional order flow in the option market. There's about 800 to 1,200 trades that hit the tape every single day, and then I try to figure out what is speculative trades versus what is a hedge. Options are used for 1 to 2 regions for institutional order flow. Calls are bought either for speculation on the upside or a hedge against a short stock. Puts are bought either speculation on the downside or a hedge against a long stock position. So we actually saw institutional order flow in the option market in TMUS, T-Mobile, and this is the only actually position I have on. So we see a big buyer on Friday. They bought 4,000 of the September 49 calls for 80 cents. Then we also saw them buy some Sep 50 calls. So you can see my position down here. I'm down about $1,200 in it. I'm long September 49 calls and September 50s. You know, if we bring up a chart here at T-Mobile, this is as pretty as a pretty chart looks. Even today, even though it's sold off from the highs, higher high, higher low, technical analysis says it's going to go higher, 52-week high in that one. And with the VIX, we see it trading around 11.5. I don't mind owning premium here. I can't imagine it going too much lower. So my trade, I'm long September 49 and September 50 calls using the option markets here. So I'm long Delta, long Gamma. I'm short Theta and long Vega. It's my only position I have on. I made some money today in Target. I was long some October 77.5 calls. I think I talked about Target last time. So TMUS I'm long, and that's the only position I have on.
I went to Target once, but I missed. All right, Barry, you're up next for your answer to your market direction for this week. What specific reasons do you think the S&P will head in that direction?
All right, let's see. I'm trying to share my charts here. Let's see if this works. Okay, it says I am screen sharing. Can you see my charts? Not yet. Let's see if it pops up here.
Yeah, I can see them.
You can?
Yeah.
Okay, great. All right, and can you see my little cursor here as well so I can point to things?
I don't think the cursor actually. Oh wait, yeah.
Oh yeah, there it is.
I was looking at Andrew's. Sorry. Go ahead.
Yeah, I can see it in my little space down there. Okay, so great. So I just have a weekly and monthly up here. So what I'm looking at is, we broke this high over here, and then on the weekly chart, I look for what I call a Pearce or for a break. A Pearce is when quite often you'll see the market just barely get above resistance, but we've held that for 4 bars. Last week was a still fairly bullish formation where, we kind of went down and tested a little bit, but then closed up near the highs again. The week before that was just a doji. And now today, obviously we're just flat today so far. But anyway, everything's up. Cycle, this is my cycle indicator. Some people talk about overbought, oversold. This would be, I guess some people would think it would be overbought, but not really, because the indicator is a stochastic indicator modified. It can only go up to 100, so market can go higher. Just because this reached the upper level doesn't mean that it's overbought. So that's still a signal of strength to me. This is money flow here. And one thing I look for money flow quite often is break of trend lines. So you see, like, you could draw a trend line here, just like we had here. Draw a trend line there. As we break above, market goes up. Draw a trend line here. As it breaks above, market goes up. So we've got another break of a trend line here. And so I take that as a strong signal. This is a momentum indicator here. That's strong. Unbalanced volume is strong. It's even stronger now than it has been. It's pretty crazy. Then as we look over to the monthly, again, I'm very, very good at predicting half cycles. So just like you were saying earlier, Dave, it's easier to predict the short term than the long term. So I'm really good at predicting a half cycle, and really that's all I need to do to make money, because I will lock in some profits there, move my stop to break even, and then what happens, happens. I'll stay in, I'll follow it. If it goes, great. If it doesn't, well, I've got my protective stop in place, but at least I locked in a little bit of money and I'm safe. So
yeah, I call it the better than the poke in the eye trade, and I'm a huge fan of doing that. Absolutely.
Yeah, and that's really the foundation of all my trading. So, this trade here, it's not a lot of money, but from a money management point of view and a risk management point of view, it's fabulous. And so, hopefully it goes. If it doesn't, well, I don't pretend to be Nostradamus. So here we got money flow. We could say it's kind of negligible right now as to whether we've broken that trend line or not, but it looks like maybe we sort of have, but it's not real convincing. And again, OBV up. We'll notice that the volume has been much bigger, and it's been going down. But sometimes what's interesting is that trends sometimes sustain with low volume. And if you have too much volume, then they get exhausted because everybody's in, and it's like,
Sometimes things will get bid up. I think that's Richard Orm's theory, is that things will get bid up because on low volume, because nobody wants to sell and they have to raise a bid, and that's kind of it's a little opposite of what the conventional wisdom is. So that doesn't surprise me. Interesting.
Yeah.
Okay. Anything else? I don't want to cut you off. I just was.
Well, I'll just show one more thing, which is maybe a little unusual since you talked about trade of the day. I don't really have a trade of the day, but I'll show you where my trade was. This is something unusual. I haven't seen other people do this, so add something a little unique here. So what this is the McClellan Summation Index, but I put a Stoke RSI on it. And then I have it again, and I put the slope indicator on it. And what I'm looking for here in situations like that is this doesn't happen too often, but when it does, it's money. And right here, it's basically a divergence pattern. And the slope, where we get equal bottoms here, but then a higher low here on the slope of the McClellan Summation Index. And boy, I'll tell you, I have traded this kind of pattern so many times. Again, doesn't set up too often, but when it does, it's really golden. That's really good. And so this is where the entry was here. Now later on over here, what we've got is the RSIs at the bottom. This is an unusual situation actually with the Stochk RSI of the index down and price actually going up still. So if you look at the past when this is down, usually price is coming down. Now here we had it where it went up a little bit and came down. So this is the one thing that's making me a little suspect about this market continuing to go up. Because if you look, like I said here, we get a little move up and then it comes back down. So until this thing comes back up like that, if it comes back up, then I'd be much more convinced, and I'd even be willing to bet, Jason's life, that'll go up further.
Oh, thanks a lot for that one.
All right, Jim, let's go to you. Jim Kenney, you know the routine.
Yeah,
what do you think?
Yeah, when we're up at these levels here, and I'm thinking about every time we change regimes, be it Carter to Reagan, or Reagan to Bush 1, or Clinton came in, and then we had Bush 2, and then we had Obama. It's hard for me to get too comfortable at 2,200 on the S&P when I know the history of the changing and regimes. So, it's hard for me to get real bullish, but I'm not going to get bearish if the tape is rising, right? So what do I know? We all know we don't know. So here's what I do know. The VIX is very low, right? We know the prices are relatively high. We know the moving averages are at about 2120 on the 50-day. I'm talking on the S&P. Is this the S&P? Yeah, there you go.
Oh, and I just pulled it up. Yeah.
Great, that's good because I'm going to relate to that. So we know the VIX is low; it's around 11, right? We know that the S&P is on its all-time high. We know that the momentum is up, or else it wouldn't be on the all-time high. We know the 50-day moving average is at 2120. You can see that corresponds to the highs around July, right? And we know that the 50-day average is at 2040. If the VIX is low, we know that the option premiums are rather low. So when the VIX is very low, generally, in my opinion, the market can either explode on the upside and the VIX stays low during the advance, or there's a pretty sharp decline coming. So if that's your opinion and you think that way, what you'd consider up here on the option side might be strangles or straddles, where you're going to buy calls and puts at different strike prices. That's called a strangle. Or you'd look at buying a call and a put at the same strike price. That's called a straddle. And what you do is you sit back and you see which way they want to move this thing. Obviously, if they don't move it at all, you lose on both sides, and it's a losing deal. But if you do get significant volatility on a big breakout, or you get a big sharp pullback, obviously one of those two options might expand dramatically because you bought it during a very low volatility environment, and you might be able to do okay on it. So that would be something that I would investigate if I was looking at the market right now. And again, the transports haven't made a new high since 2014. The Russell and the New York Composite, which are much wider indexes, are not near their highs, really. And so, that's where my suspicion comes in. But, you don't have an opinion that does not match up with the price action. That's how you lose money, right? So you have to have price confirmation. You can't just walk around with opinions. So right now, yes, right now, since my opinion is prejudiced to the downside, but the prices are not confirming it, I would lean more towards a strangle or a straddle and see if this market can make its own decision, and I'm positioned on both sides.
Yeah, I often say believe in what you see and not in what you believe. So I'm
well,
with you.
Like I say, if I think it's going to drop and I'm in a strangle or a straddle and it goes up to 2220 on the S&P, I certainly will still accept the money on the call side.
I hear you.
Even though I was wrong about where it was going to go, I'll still accept the money on the other side.
Yeah, I want to say, similar on a similar vein. It's like I get clients, and at the end of the trend, as all trends will eventually end badly, they give up a little bit of money and they complain. I'm like, well, just send me everything you made on the trade, and go center yourself, keep a little money out, have a massage, forget about it, and I'll be happy to take that money. And I haven't gotten a check in 20-something years yet, so amen on that. And don't worry about being right on everything, just worry about making money. As far as the S&P 500, I think that one, as a trend follower, I can't argue with new highs. I was a little bearish for quite a while. We did go in this wide and loose manner. We had a sell signal back here somewhere, and it really didn't pan out in a huge way. One thing that does have me concerned a little longer term is that the buy and hope crowd has been rewarded big time over the last 5 or 6 years, or maybe since I guess 2009. And in 2013, we had some pretty big zigs and zags, and they held through it, and they were rewarded. The same thing happened in 2015 and 2004. One thing to worry about is when a market is at new highs after all this wide and loose trading, is that if the Johnny-come-latelys begin to bail out, it could push us back into the range. And usually that's the fast money, but you can't talk in those, I guess, what would the world be without hypothetical questions? But you can't really talk about that or worry about that too much. You just have to wait for it to happen as a trend follower. One thing that I have noticed as a trend follower is the market is going very much sideways. And years ago, I did a lot of research into volatility, and one thing that's kind of cool about volatility is after it compresses, you get an expansion, and then usually that expansion is more than just a reversion to the mean. It's something much bigger in the expansion. And the other thing is, if you wait for it to fake out when volatility compresses like this, you could take the move when it comes right back above the fake out. So that would have been a buy last week. So that's a short-term signal. It's not something that I try to time the markets with longer term. As a trend follower, it's just a little tool in the box to kind of keep an eye on things and kind of help me along. But so far, I'm not going to argue with the market at new highs. As someone pointed out, I think it was Jim, the Russell 2000 and the broader market has lagged a little bit, but the Russell is starting to get its act together. And I look at about 2,000 or so charts every day, and it gives me a pretty good feel for what's going on internally. And I think that internally the market is improving a little bit in spite of some of the narrow breadth measurements that are out there. That's not a margin call, but we still have a little bit of yeah. Don't answer it. It's a margin call. We still have some overhead supply to deal with in Russell, but hey, so far so good. What is it's cutting through that. So S&P 500 so far kind of bullish on the S&P. We're a pullback player, so we're not seeing a whole lot of setups. And I'll show you a setup. In fact, I'll show you a setup here in a minute, or possible trade of the week. But for now, I still think we're headed higher. There's always something to worry about. Obviously, we didn't really clear this prior high decisively just yet, or very much decisively. I'd like to see us a little bit higher in here. And if we do begin to sell off, or we do have a next correction, it could put us back into this soup. But let's not worry about that until that happens, and that's what stops it for. All right, let's go to you, Andrew, for the question of the week. And the question of the week is, do you have a set, well-defined trading plan that you always follow? If so, how did you develop it? If not, why? And did it say Andrew? Or did it say Barry?
Sorry about that. Can you hear me now?
Andrew, yeah.
Okay, so my trading style is very unique and very different. Basically, when I traded on the trading floor for 10 years, basically we just watched institutional order flow in the option market. We all know that institutions are trading on insider information, and it's a fact. And Andrew Sorkin actually did a study, and he said 25% of all mergers and acquisition, there's basically order flow in those options. Because if I knew, hypothetically speaking, the stock was going to go from 20 to 40, instead of buying the stock and making 100% gains, I could buy an upside call and make even 1,000% gains. So what I do is I watch institutional order flow in the option market. I watch about 8 to 1,200 trades, and I look at the option volume. So every single stock has stock volume of trades in a day. Options are the exact same way. So maybe like TMUS, T-Mobile trades 2,000 options in a day. On Friday, it traded 9 times usual volume. So I just watch this institutional order flow in the option market. I set up stop losses and I set up targets, and this is the same way I've been trading for 14 years, and I haven't had a losing year since 2009. And I'm a pretty large trader. I probably trade close to maybe 1,000 options in a day, depending on the day. Today's been a little bit slower, but that's basically what I look at institutional order flow in the option market.
Cool. Dave Cosmenter, you might want to mute Jim's mic. We're picking up some noise off of him, or if Jim.
No, I'm okay. I'm okay. Yep.
Okay.
I'm with you.
You might just want to mute your mic. We're picking up a little bit over there.
Okay, I got you.
No problem. All right, Barry, let's go to you. Do you have a set, well-defined trading plan that you always follow? If so, how did you develop it? If not, why?
All right, yeah, I definitely do. It's, as I've mentioned earlier, it's evolved over time. from simplicity to complex back to simplicity again. And it reminds me actually of a quote from Bruce Lee, one of my idols that I grew up with him and watching him, and I do martial arts. And anyway, Bruce Lee said, when you let's see, how did he say it? At first, when you start training in Kung Fu, or before you train in Kung Fu, he says you think a kick is just a kick and a punch is just a punch. Then you start taking Kung Fu and you realize, oh, a kick is not just a kick and a punch is not just a punch. Then when you master Kung Fu, you realize, yeah, a kick is just a kick and a punch is just a punch. And that's really the story of my trading. It started out, I thought, oh, this looks so simple, looks so easy. And then when I got into it, it's like, after losing a bunch of money, I'm like, yeah, this ain't so easy. So I better start really learning. So I took so many different classes, of course, my dad, and then beyond that, because my dad wasn't a day trader as such, and I wanted to do day trading, wanted to do futures and Forex, things he wasn't doing. And I got so involved in all these complexities, and now what I do is I really just look at basically 5 things, and they all have to do with the same core, and that is the money flow of the market, what's happening right now. I've totally given up on trying to predict or forecast what the market's going to do. In 2020 on July 7th, that's not going to happen. So now I'm very focused on what's happening right now, where the money is flowing. So I start out with trend, and I look at that. That just helps me determine which direction. So that's one. There's 5 steps I go through. That's step 1. Step 2 is then momentum. I'm looking for strength. Is this trend strong or weak? And for that I look at velocity or acceleration, and also volume. But volume then gets broken down also, so Andrew's talking about there, and that is I'm looking for block trades, because not all volume is created equal. Who's trading? Is this amateurs, or are these 1 lots, or are these 100 lots? And that makes a huge difference. So I want to trade with the smart money, not the dumb money. And just like Jason, smart money investor. That's what I want to be. That's what I am. So I'm watching the smart money. And then, so trend, is it strong or weak? And then number 3 is cycles. That's timing your entries. A lot of times people will look at a simple retrace, get in, and it turns out to be a complex retrace, they get stopped out. And then after that, the market goes in their direction. So I studied under one of the great cycle mentors, and that changed my trading dramatically, because everybody can trade the y-axis, the price axis, but not many people are taught how to trade the x-axis, the time axis, and yet that's fully 50% of a 2-dimensional chart. So that's the 3rd thing I look at. The 4th thing I look at, that is the y-axis, which is support resistance. And the 5th thing I look at is multiple time frames, so what I call the energy of scale. And to see I'm trading in the same direction as the longer term chart, but I'm a little different in that I don't really care what the trend is on the longer term chart, because trend is very lagging. So I actually trade in the direction of momentum on the longer term chart. So that's my 5-step checklist, and that's what I do every time, whether I'm trading stocks, futures, Forex, day trading, swing trading. Yeah, it's down to those 5 things, and that's it. That's all. I turn off CNBC, I turn off Bloomberg, and I just look at what's happening now.
Yeah, a corollary to some of the martial arts stuff is I like what Tyson once said: everyone has a plan until they get punched in the face. So that's where the trading psychology comes in.
Yes, exactly.
All right, Jason, let's go over to you. Do you have a set, well-defined trading plan that you always follow? If not, how did you develop it? If not, why?
I do, and after the show, I'm thinking I'm going to have to talk to Barry, because somehow we might be distant cousins or something. Same thing. I went from simple to complex when I got really smart. Unfortunately, the market didn't know how smart I was, and here I am, full circle, going very simple again. I like trend, and the way I define trend is price structure. Then I'm going to look at momentum to make sure that the trend is not running out of gas. Much like a rocket needs the fuel to keep it going, a trend needs that momentum. And I also like the multiple time frames. If I can get agreement on 2 or more time frames, I feel like I'm in the great position. And finally, as a trend follower, I try not to put targets or predictions on where it's going to go. So if I can see based on the volatility and the momentum that I've got a nice, they say pick your spot, so I can pick a nice little setup on a small retracement, put a tight stop. Even though I don't have an upside target, I know that my risk reward is still going to be high. So I could be kind of like Babe Ruth. You know, he was the home run king, but he was also the strikeout king. So accuracy doesn't matter like it does to a novice. And I just try to apply the same thing over and over, whether I'm doing futures or stocks or ETFs. And I guess since Barry's quoting Bruce Lee, I'm going to do the same thing. He said, I don't fear the man who's practiced 10,000 kicks once. I fear the man who's practiced one kick 10,000 times. And that's basically it, becoming an expert in one thing and doing it really well.
Absolutely, absolutely. I see people who should know better, 10, 15 years into their career, and they're still emailing me, what do I think about this system and that system? Like, good God, you haven't found something simple yet? Maybe you need to find something else. But absolutely, I often, as I alluded to earlier, I often do a trader's journey where I show a blank chart and show all its complexity, then come right back to the beginning. And Bollinger had a really good quote, was a byline of when basically it says the true enlightenment. I wish I had it in front of me right now, but it's like the true enlightenment comes when you reach the beginning, and I fully believe that. Jim, we hadn't forgot about you over there.
Okay.
Jim, what
Yeah,
do you have a set, well-defined trading plan and so forth?
Yeah, no, I'm not using one specific plan because with options there's so many different things you can do. But there are some steps I go through. One is assessing what the market that I'm looking at is all about. I like to look at the moving averages, and I like to look at them on a short, intermediate, and a long-term basis. I like to look at the monthly ranges, high and lows. And I like to look at whether the market might be overbought or oversold, reversion to the mean, and then I like to look at some of the Fibonacci numbers. These are some of the things I look at to get an idea of where I think this thing might be going. And of course, all of those things are based on actual numbers. They're not opinions. They're based on actual prices. And then after you figure out where you think it might be going, you go through the universe of option strategies, covered calls, debit and credit spreads, long calls, long puts. Some people think long calls and long puts because they're a simple strategy or bad. Quite frankly, I would say the majority of the time they're one of the better strategies. And then, of course, collars. If you have a position, you got a lot of money in it, you want to figure out how to collar it so you can walk away with money, but also stay in the game and try to make a little bit more money on it. Collar position, and 2100, 2200, 2400. I mean, we are not getting less risky every time it goes up another 100 S&P points. I always try to remember from the past. Gold didn't get less risky when it went to 1900. The price of JDS Uniphase, to go back in history, didn't get any less risky when it went up higher. So the higher you get, the more you want to drift over towards something that protects those gains, as opposed to just wildly keep buying into it as if it'll never drop. So, I like to look at the, shall we say, the level of the land, and then try to find which strategy might put me in the best position to try to win.
Gotcha. When this question looks somewhat familiar because David Kosminer asked me for some ideas last week. And one of the ideas I submitted was why people don't plan trades, and I see he turned it to a little bit more of a positive. So I kind of came in for...
thank you for suggesting or making some suggestions for the question this week. So I took what you said and used the basic idea, I think.
Yeah, no, cool. No, well, the reason I brought that up is because one of the things I submitted to David was why people don't trade. So I just want to touch upon that real quick, and that's more of a psychological thing versus a methodology thing, like everyone chimed in on, which was great. But most people don't plan their trades because the moment you plan a trade is the moment you admit you can be wrong, and I think a lot of people don't want to admit they can be wrong because you have to have some sort of damage control, some sort of stop in place when that happens. And I think that they find winging it's a lot better. We had a situation this morning with a stock and got a little out of control on an entry. Kind of a long story, but I got one phone call on that out of all of my clients, and the guy's like, well, your phone must be ringing off the hook. And I'm like, no, because people aren't following the plan. So they're not confused about what to do. So I think people don't follow the plan because the moment you follow the plan is the moment that you have to admit you're wrong. The moment you make a plan, obviously. And then the other thing too is it's kind of boring if you're following the plan. And I tell a lot of people, I've got a few doctors, and they tend to be bad traders. I tend to pick on them a lot because they're smart and they forget how long it took them to become a doctor. They don't have those 10,000 kicks in just yet. But they often say that, you know, I have to try to tell them, it's like, if you're doing this right, it's going to be boring, but they often like to wing it because it's much more exciting and try to catch that stop that's dropping like a rock, even though you're a trend trader. As far as my actual plan, if you look on the homepage of my website, this is about a week old. This is my service delayed, but every day, if there's a stock I recommend, there's a place to buy it, a place for a stop, a place for initial profit target, and my risk, and then obviously the pattern. And all you have to do, I don't know, easier said than done, is just follow the plan. But what's going to happen is the stock's going to trigger, and then my inbox is going to fill with emails tomorrow asking me what to do with the stock. And if they took the trade, nothing, honor your stop. And if they didn't take the trade, which a lot of them don't, then now you're creating extra decisions for yourself, and that makes life a lot tougher. So I could probably go on and on the psychological basis of why you need a plan, but you do have to plan your trade and trade your plan. And I know it's easier said than done. I know it's cliche, but along the lines of everybody's answers, as far as developing that plan, the first thing I want to look for is I want to look for either an obvious or an emerging trend pattern. And emerging trends are a little bit tougher to recognize, but
looks like Dave got kicked off the room somehow. So does anyone else have any comments while we're waiting for him to log back in?
Yeah, it looks like he's gone. He'll be back in a minute, I'm sure.
Perhaps this is the result of Barry's losing trade. There goes Dave's life. I don't know. Somebody getting stopped out.
Good one. Quick. I like it. Quick mind. Interesting. We're all Bruce Lee fans here.
If you've gotten beat up in the market, you might as well learn it in real life.
You know, I like that Tyson quote too. You know, everybody has a plan until they get punched in the face. That is so true. So true.
Looks like he's back.
Yay!
And that concludes the secret of trading. Any questions? Oh, looks like my time is up. No, sorry about that. I figured something. I think that's my problem. But in developing the plan, as I said earlier, either an obvious trend or an emerging trend. Emerging trends is a little bit more difficult, something I would recommend for somebody who's a little bit more advanced or at least understands trends. But obvious trends should be pretty obvious. I'm known as the trend-following moron. Somebody called me that years ago. They were heavily short, and I kept writing in my column that the market was going up, and I kept drawing an arrow, and they got very angry with me because they weren't believing what was actually happening. So an obvious trend, you should be able to draw an arrow in the chart. Ideally, you want some acceleration and some persistency, meaning that the trend tends to go up day after day. You do not want to trade a chart that looks like an electrocardiogram. And that it surprises me about how many people will see charts that look just like an electrocardiogram. And I have quite a few things I call trend qualifiers. I'm looking for wide range bars in the direction of the trend, gaps and laps in the direction of trend, and things like that. So the bottom line is it should be pretty obvious, and then I'm looking for a pullback in that trend. One of my favorite patterns, if you have a wide range bar down against the trend, because that knocks out some people. I actually call it a trend knockout or a TKO. With the TKO analogy that the shorts are attracted in, and as the market begins to rally, they get squeezed out. But based on all that, I have a plan in place which has an entry which is above the market, meaning the market has to go higher to trigger, and once triggered, I have a stop that is outside the normal volatility of the market. I think Barry, if I'm not correct, or what you guys were talking about, a complex retrace versus a simple retrace. And if I'm in a complex retrace, I never thought about it like that, but as long as I'm outside the normal volatility of the market, just in case my timing is a little off, I could survive that normal zig and zag. And then I take partial profits, as I think who was saying? Jason might have been saying. So you could be right. At least you get something off the trade, and then you bump the stop up to break even on the remainder once that initial partial profit target is hit. Anyway, I've got this all outlined in that aforementioned report that I talked about earlier. Sorry about the glitch with the software a minute ago. Andrew, we're going to go back to you. Do you have a free trade of the week that you'd like to share with us? If not, just let us know if you have any closing thoughts.
Yeah, I think I mentioned T-Mobile. So T-Mobile September 49 calls for about 90 cents. We're the trading right now. Or September 50 calls for 55. I think those are both in my realm. I like them both. I think T-Mobile goes higher. I think the market goes higher. You can go to www.alphashark.com to get any more information. Like I said, we have four subscription-based models. We have, I think, about 15 educational courses on demand and DVD, and then we have about 4 proprietary indicators. So we have a lot of different things you can trade with. Unusual option activity is really my bread and butter. That's what kind of I focus on.
Okay, cool. Okay, Barry, let's go to you next. In fact, let's go ahead, since we're going a little long today, let's go ahead and do both at once. If you have a trade of the week, let us know. And then either way, any closing thoughts you'd like to tell us about TopDogTrading.com or your own trading?
Okay, yeah, thank you. Oh, good, I'm unmuted. I thought I was muted there for a second. Yeah, so I'm just looking at the markets here. I kind of got ahead of myself earlier, and again, I'm just looking for the McClellan Summation Stoke RSI to hook up before I'm really convinced. But so that's kind of what I'm watching. If that goes up, I'll probably go ahead and take position back into or add to position here. As far as Top Dog Trading goes, I do offer a free mini course for anybody who's interested. Just here at my little notepad there, I added it, topdogtrading.com/free.html, and 5 little short videos, about 20 minutes each. So it goes through a lot of the things that are counterintuitive, things that people get wrong on a regular basis, and how professionals trade different than amateurs. And I even include a free trade setup in there I call my rubber band trade, and it's a real good trade. I trade it pretty much every day, and it's got a super high win-loss ratio, and I give the trade setup there and all the rules for it. So I like to provide value for people, and just start by educating. I don't sell people into my courses, I educate people into my courses. So I give away a lot of good free education, and that's a good place for people to start.
Cool, cool. All right, Jason, you're up next.
Okay, I'm going to, hopefully this chart is showing. I'm looking at the hedge fund hotel, the Apple stock. Normally as a trend follower, I like to buy the things that are breaking out the new highs, especially if it's leading the market, but there's some exceptions. Everybody knows about the 200-day moving average. I like to clean it up a little bit and use, say, a 40-week moving average. I kind of feel that if you're looking at the bars on the weekly, it has a little bit more significance because it's not just close, hold it overnight. It's close, hold it over the weekend. So it kind of cleans it up. And Apple's just done a tremendous job of following average. We bounced up the last couple of times, hit the 40, rolled over. There was your short sell, but something happened the week before last. We closed above that 40-week moving average. So the 1-year bear trend in Apple looks like it may be over. So my thought is buy the shallow dips on there, and until it closes the week below that 40-bar moving average, start going long on that thing.
Okay, cool. Okay, Jim, last but not least, well, I guess I'll be last and least. Any trade of the week and any closing thoughts?
Well, I have some closing thoughts. I think you're kind of a fan of Jesse Livermore, aren't you, Dave, a little bit?
Absolutely.
So one of the things he talks about, among many things, is sitting on some things that you think are a good idea and trying to obviously take advantage of a longer-term possibility. So looking at some things that I'm trying to, in my view, take a look at that might be worthwhile to look at. Because I'm kind of thinking that this debt situation is going to have a consequence in the intermediate term, which means in the next 6 months. And basically, I am looking for things that might benefit from some type of a crisis that would come out of the just tremendous corporate debt and tremendous government debt and even the municipal debt. You know, you got some states that are issuing debt just because they want to make their interest payment. And these are the things you hear at the end of a cycle, not in the beginning of a cycle. And they use Brexit, obviously, as an excuse to bring the 10-year note down to 1.3 almost. And they could use another crisis to take the 10-year note even under 1% and get closer to where the rest of the world is, which is at 0 interest. At any rate, the amount of debt, if it's not backed by any kind of revenue coming in, sometimes end badly. So the three things that I'm kind of looking at is this, is the S&P. I'm sitting patiently looking for something to develop on the sell side. Because, again, I do think that when they change the presidents, as in years past, there could be some events that would reprice the market for the new guy, which they seem to have done under the other years, if you look back, when we've changed regimes. Okay, so that being said, you look at the previous monthly lows on the S&P, and if it starts taking out the previous monthly lows, and even the previous weekly lows might give you some indication, but the previous monthly lows, that might be an indication of a more significant turn to the downside. So I'd be watching out for that, using the previous monthly lows as some type of a indicator, and certainly closing prices under 2,000 would be very negative. Keeping an eye on that in the weeks and months ahead. Number two is the metals. I think that they have made a turn. I think that the lows may very well be in. And I think that with the depreciation, as you see, of all the paper currencies, there could be a very good future in the metals. And the silver to gold ratio. When we went to 1900 gold and $50 silver, the ratio was 40. That makes silver very overvalued to gold, and the drop of 70% in silver versus the 40% gold is evidence that there might be truth to that. Now at the bottom, $14 silver and 1100 gold, your ratio is more like 80 to 1. That indicates an undervalued silver versus gold, and you've seen silver go up 40% or better, while gold's only gone up 20% or better. I think the future for the silver or the gold, but preferably the silver, because of the ratio still at 67 to 1, I think the future is quite bright for that, and the moving averages are kind of confirming that we might have seen a low that might hold for a while, and with the things that I think could occur, that market could benefit. Certainly the mining shares have been a stellar performer in the last 6 to 12 months.
Yeah, plus one in the metals. I'm a bull there too.
All right, so so I'm watching to see, because I don't want to join Dennis Gartman in I shorted too early club. I would like to be patient because I think it will be coming. I think that they're making it very difficult for people to sell, and sometimes that is something that happens at the end of a cycle. And so I'm kind of waiting in the bushes for some kind of a position that I can feel good about on the sell side. And then finally, the price of oil is very interesting to me because we went from 29 or 27 or whatever up to 53. We've pulled back about the 60% into the 37, 39 club, and that could be a 1, 2, 3 formation. So if we can take out 50 or 53, I think the oil market and the oil stocks and the integrated oils and all those guys that are paying those big fat dividends could be a heck of a thing to be in, but I would be hesitant to do much on it until we took out that point that we created on that rebound rally to 50 to 53. So I think those are the three longer-term sit-on-them type deals that could be of value in the next 6 to 12 months. And, you know, in addition to what we do every single day for people trading, it's nice to take a wider lens on where some major activity could occur if some of these things that I think might happen, which is the election effect, as well as this quiet killer, which is the debt explosion. Because I just seen so many things like this in the last 30 years, 40 years, where, you know, if you get this much activity, I mean, emerging markets got their biggest inflows, I think, last month, they were saying. So people are just desperate for yield. And they're calling in all the bonds that have decent yields, reissuing these 1% and 2% yields. And I don't know about you guys, but I don't want to put up $1 million and get 1% out, because the guy who just took my $1 million is only got to owe me 10 grand. And he, you know, all he's got to do is give me 10 grand, and I got to hope I get the principal of $1 million back. So
Yeah,
if there's a redemption run, and you saw a tiny one in corporate bonds about a year or so ago, which people who obviously have short-term memories, the whole world has short-term memories, they don't realize that that was just a little bit of a run, a little bit of a redemption run. If you had a significant redemption run, you know, it's going to be a problem, and I don't know that it's going to happen in a week, a month, or a year, but certainly the potential of it happening is on the table. So those are the three things that I saw.
Yeah, I like the it's like I always learn something from these shows, and I never thought about the well, you owe me $10,000 and you got me $1 million. That's pretty interesting angle on that. I'm going to have trouble sleeping tonight, but thanks a lot for that.
Hey, how do I get in that?
Well,
job?
everybody's got a deal, and a deal on a bond is they're gonna borrow money from you, and then they owe you your money back at some point, and then they're gonna pay you a yield, right? Well, they're paying you absolutely a peanut, and they're taking all your principal in.
Yeah.
At some point, somebody knocks on the door. Hello, I'd like my principal back. And if enough people knock on the door, then the guy on the other side of the door might go to Antigua.
Gotcha. All right.
I think we just saw that in Puerto Rico on a smaller basis, right?
Oh, goodness gracious. Okay, let me wrap it up as quickly as possible here. As far as trade of the week, this is one that we're already long. This is an IPO retrace type of pattern, but I still think it's worthy of a trade. I'm not a breakout trader, but there is a breakout pattern in IPOs that I haven't fully disclosed, except for those who have the course. But 99% of everything I do is all fully disclosed. But as far as the entry on that would be 20, and then believe it or not, you need a really wide stop on this. This is super speculative, so your stop will be down at 17. What's got me a little bit nervous, as one of my clients pointed out today, is that the volume has dropped way off on this IPO, but I still think it has a tremendous amount of potential with fairly reasonable risk based on risk to reward. I do a weekly webinar every Thursday, so if you guys want to, some of you guys out there want to show up for that, love to have you. It's interactive, so bring your questions and bring your favorite stock picks, and we'll have a look at them. Usually I lecture for 30 minutes to an hour, and then we take a look at the markets and then your favorite stock picks. Lately, as far as kind of big picture ideas, what's amazed me as the IPO bull market just keeps going and going. It's like the Energizer Bunny. I keep thinking it's going to end, and every time I think it ends, it has another leg to it. I'm a big fan of inefficient markets versus efficient markets. As was said earlier, you've got a lot of players fighting each other out with all the derivatives and S&P futures. I'd much rather trade something like a little IPO than S&P futures or maybe a metal stock. And right now, I'm seeing inefficiencies in the metals and the IPOs. Overall, in stocks in general, if this market continues to follow through on pullbacks, we should start seeing a plethora of setups. And I think that pretty much wraps it up. David, let's go back to you. Thanks again for having me host, and I'll let you give everybody final thanks. But just for me, this was a great show, and I know I often say this, but I think this was one of our better shows. So thank you guys, Jim, Andrew, Jason, and Barry. I really enjoyed the show, and hopefully you did too. David, back to you.
Yeah, thanks, guys. Great show. So just want to remind everyone watching, you can go to TimingResearch.com, and you can download any of the past reports. You can also view any of the past shows, including this one. Will be up on the main page in a few minutes. Join us on the show next week. Tom Essay of SevensReport.com will be on. He was supposed to be on a few weeks ago, but he had to reschedule, so he'll be on next Monday. Also Adam Johnson and Dean Jenkins. So and then just want to thank all my guests for this week: Barry Burns of TopDogTrading.com and Jason Pearce of SmartMoneyInvestor.com. Thanks for coming on for the first time. Hope to have you back in the future. Andrew Keene of AlphaShark.com and Jim Kenney of OptionProfessor.com. Thanks, guys. And Dave Landry of DaveLandry.com. Thanks for hosting again.
Thank you, Dave.
So, all right. Thanks, guys.
Thank you.